In Chapter 1, Robert Kiyosaki opens the book with a simple but sharp question. Who took my money? It's not just a complaint. It's a wake-up call for every investor who wonders why their savings and investments never seem to grow as expected. Kiyosaki uses this chapter to expose how much of the financial advice we receive actually comes from salespeople, not true investors. He begins by explaining that most people don't realize they are surrounded by financial salespeople. These include stockbrokers, mutual fund managers, financial planners, insurance agents, and even bankers. Their job isn't to make you rich, it's to sell you financial products. Every time you buy mutual funds, insurance, or retirement plans, someone earns a commission. The system, Kiyosaki argues, is designed so that your money works for others before it ever works for you. He contrasts two mindsets, the sales mindset and the investor mindset. The salesperson's goal is to make a sale and move on. The investor's goal is to make money grow and create cash flow. Most people, without realizing it, let their financial future be directed by salespeople who benefit whether the market goes up or down. That's why so many investors lose, because they never truly learn how to make money work for them. Kiyosaki reminds readers of one of his classic lessons from Rich Dad, Poor Dad. The rich don't work for money, they make money work for them. But here, he adds another dimension. The rich also don't let salespeople control their money. Instead, they focus on acquiring financial education and building assets that produce cash flow. He calls this financial control, knowing exactly where your money is going and what it's doing. Through simple examples, Kiyosaki shows how the average investor hands money to a mutual fund and hopes for the best, while professional investors take time to study deals, understand markets, and manage risk directly. The slow investor, as he calls it, depends on traditional financial products and long-term market performance. The fast investor understands how money moves, takes calculated risks, and uses financial intelligence to make decisions quickly and precisely. He also touches on the psychology of investing. Many people invest emotionally, out of fear of missing out or blind trust in experts. This emotion-driven behavior keeps them stuck in the rat race, feeding the system that profits from their lack of knowledge. The antidote, Kiyosaki says, is education before investment. Don't ask a salesperson what to do with your money. Ask yourself, what do I know about how money really works? The chapter ends with a challenge. If you want to know who took your money, start by looking in the mirror and asking who you've been listening to. True investors don't buy products, they build systems that make money. And that begins by recognizing the difference between advice that sells and advice that builds wealth. In Chapter 2, Robert Kiyosaki introduces one of his most memorable analogies, the difference between a cattle rancher and a dairy farmer, to explain two distinct investing mindsets. This simple metaphor captures a powerful truth about how the rich manage money versus how average investors do. Kiyosaki begins by describing how most people treat their investments. Like a cattle rancher treats his herd, they raise cattle only to sell them off for profit. Once the cattle are sold, the rancher is left with nothing but cash, and the cycle starts over again. Similarly, most investors buy assets with the intent to sell them later for capital gains. They speculate, hoping prices go up. This buy low, sell high mentality dominates traditional investing, especially in stocks, mutual funds, and real estate flipping. It sounds logical, but as Kiyosaki points out, it's fundamentally flawed because it relies on market timing and luck, not steady cash flow. The dairy farmer, on the other hand, focuses on continuous production. Instead of selling the cow, he milks it day after day, creating a consistent stream of income. This is how the rich invest. They acquire or build assets that produce cash flow. The goal isn't to sell. The goal is to collect income again and again, for as long as possible. In financial terms, the milk represents passive income, money that keeps coming in whether you work or not. Kiyosaki emphasizes that most traditional investors are taught by salespeople and financial institutions to be ranchers. They're encouraged to put money into the market, hold for appreciation, and sell when the value goes up. But when markets crash or interest rates shift, their wealth evaporates. The system benefits financial intermediaries, brokers, fund managers, and banks who earn fees and commissions regardless of whether the investor wins or loses. Meanwhile, true investors, the dairy farmers, continue to collect income from assets like rental properties, royalties, dividends, or businesses, even during downturns. He uses this analogy to stress a critical principle. Cash flow is real. Capital gains are hopes. Capital gains depend on external forces, the market, the economy, or other people's willingness to buy. Cash flow, however, is internal. It's generated from within the asset itself. That's why financially intelligent people design investments that produce income, not just potential resale value. Kiyosaki also connects this to mindset. The rancher mindset focuses on short-term profit. The dairy farmer mindset focuses on long-term sustainability. The rich think in terms of systems, how to create ongoing streams of money that feed their wealth indefinitely. This is why, even when markets collapse, they don't panic. Their cows still produce milk. The chapter concludes with a practical takeaway. Stop thinking like a seller and start thinking like a producer. Don't chase the next hot stock or real estate boom. Instead, look for ways to build assets that generate consistent cash flow. Wealth isn't created by buying and selling. It's created by owning and managing productive assets that keep paying you long after the work is done. In Chapter 3, Robert Kiyosaki dives into one of the most misunderstood relationships in personal finance, the one between investors and banks. He begins by pointing out a truth that most people never question. Banks are not designed to make you rich, they are designed to make themselves rich. This chapter reveals how banks use your money to create wealth for their shareholders, while teaching you to save, a strategy that actually keeps you poor. Kiyosaki starts with a simple observation. When you deposit your money in a bank, you think it's safe and growing, but in reality, the bank immediately lends it out to someone else at a higher rate. They pay you a tiny interest, maybe 1% or 2%, and then charge 8% or more to borrowers. The spread, the difference between what they pay you and what they earn, is the bank's profit. It's a classic example of the fast money system that Kiyosaki contrasts throughout the book. The bank is a fast money operator. The average saver is the slow money participant. He then reminds readers that banks love debt, as long as you're the one paying it. But the rich use debt differently. Instead of avoiding loans, they leverage them to acquire assets that generate cash flow. This is what Kiyosaki calls good debt, money borrowed to buy something that puts money in your pocket, like rental property or a business. The average person, on the other hand, uses bad debt, borrowing for things that take money out, like cars, vacations, or credit card purchases. Banks encourage this behavior because consumer debt is their most profitable product. To illustrate, Kiyosaki explains how his rich dad taught him to think like a banker. Banks create money through lending. They use other people's money OPM to generate returns. A true investor does the same thing, uses leverage intelligently to acquire productive assets. The difference is that most people fear debt because they've only been taught to be borrowers, not lenders. They're trapped on the wrong side of the financial equation. He also criticizes the traditional advice to save money in an inflationary economy. Saving cash is losing money slowly. While your dollars sit in a savings account earning minimal interest, inflation erodes their real value. Meanwhile, the bank uses those same dollars to earn exponential returns through loans and investments. This is why Kiyosaki calls savers losers, not as an insult, but as a warning that the rules of money have changed. Another key lesson from this chapter is about financial awareness. Kiyosaki urges readers to ask their banker questions, not about savings accounts, but about how banks invest. You'll quickly see that banks don't follow their own advice. They don't save and hold. They invest, lend, and multiply money constantly. So why should you follow a system that even the banks themselves don't believe in? He concludes the chapter by urging readers to stop being passive participants in the banking system. Instead of letting banks use your money, learn to use the bank's money intelligently. Understand leverage, manage risk, and make debt your servant, not your master. The rich don't keep money in the bank. They use the bank to keep their money working. Once you understand that, you stop asking who took my money and start realizing how to take control of it. In Chapter 4, Robert Kiyosaki shifts focus to another powerful player in the world of money, the insurance industry. He uses this chapter to expose how most people misunderstand insurance, turning what should be a tool for protection into yet another slow money trap. The central message is clear. If you rely on insurance companies to make you rich, you'll stay poor. But if you understand how the rich use insurance, you'll see it as part of a larger financial strategy, not the entire plan. Kiyosaki starts by explaining how traditional investors are taught to see insurance as security. People buy life insurance, retirement plans, and annuities because they fear risk. These products promise safety, guarantees, and long-term returns. But in reality, most insurance products are designed to protect the company first, not the investor. Just like banks, insurance companies operate on leverage. They collect premiums from millions of people and invest that pool of money aggressively. The policyholder gets slow, predictable returns, while the company earns fast, compounded profits. He points out the irony. When people say they're playing it safe with insurance investments, they're actually handing control of their money to someone else again. It's the same pattern repeated from earlier chapters. The slow investor gives up control for the illusion of safety, while the fast investor takes control, accepts measured risk, and gains higher rewards. Kiyosaki emphasizes that safety without control is not real safety. It's dependence. Kiyosaki then introduces one of Rich Dad's key teachings. Insurance is for protection, not investment. It's smart to insure yourself, your business, and your assets against catastrophic loss. But when people start using life insurance or annuities as an investment plan, they're missing the point. True investors protect their assets and grow their wealth separately. They don't confuse the two. The rich may use advanced insurance structures, like whole life or infinite banking concepts. But even then, their goal is leverage and tax efficiency, not passive hope. He also uses this chapter to talk about financial education and responsibility. Most people buy what their insurance agent sells without asking the right questions. Agents, like bankers or brokers, are salespeople. Their goal is to sell policies. They're trained to emphasize safety, emotion, and family protection, not financial performance. Kiyosaki challenges readers to take responsibility for understanding what's behind the contract, where the money goes, how it grows, and who really benefits. To make this point clearer, he compares the behavior of rich and poor investors in relation to insurance. The poor see it as a safety net. The rich see it as a shield. The poor want guarantees because they fear loss. The rich create systems that minimize loss through control, not promises. The poor invest for comfort. The rich invest for freedom. Kiyosaki closes the chapter with a reminder that every time you hand your money to someone promising safe returns, you're effectively saying, "Here, you control my wealth." The lesson isn't to reject insurance, but to use it wisely as a form of protection while you actively build cash flow assets. The true investor doesn't hide behind financial products. They learn the rules, manage risk, and make the system work for them. Real wealth isn't insured. It's created through knowledge, control, and courage. In Chapter 5, Robert Kiyosaki takes on one of the most misunderstood and emotionally charged topics in personal finance: taxes. This chapter reveals how taxes silently drain wealth from the poor and middle class, while the rich legally avoid them through education, planning, and strategy. The message is clear. If you don't understand taxes, you'll work harder for less. But if you do, taxes can actually make you richer. Kiyosaki begins with a hard truth. Most people think paying taxes is patriotic and fair, but they don't realize how the tax system is designed to reward certain behaviors and punish others. The government uses taxes as an incentive system. It rewards those who create jobs, build housing, or invest in businesses, the very activities that stimulate the economy. At the same time, it penalizes employees and savers, the people who earn wages or interest income, because their income is the easiest to tax. This is why, he says, the rich don't work for money. They work for assets that produce cash flow with tax advantages. He draws a key distinction between how different classes earn money. Employees earn earned income. Which is taxed at the highest rate? Self-employed people may have more deductions, but they still pay heavily. Business owners and investors, however, earn passive or portfolio income that often comes with lower tax rates or even deferrals. The tax code is essentially a guidebook for the financially educated. It's not about cheating the system. It's about understanding the rules and playing by them intelligently. Kiyosaki uses the example of real estate investors to make his point. Real estate offers tax deductions through depreciation, interest write-offs, and 1031 exchanges. These legal tools allow investors to reduce or defer taxes while still earning cash flow. In contrast, the average person pays taxes first and spends what's left. The rich, by structuring their investments properly, spend first and pay taxes last, or sometimes not at all. This is the power of financial education, knowing how to position yourself on the right side of the tax equation. He also criticizes the common mindset of working harder to make more money without tax knowledge. Making more simply means paying more. The harder you work as an employee, the more the government takes. Kiyosaki argues that financial ignorance makes you the government's best asset, a reliable taxpayer who never questions the rules. In contrast, the rich use corporations, trusts, and partnerships as shields, legal structures that protect income and assets from excessive taxation. Kiyosaki emphasizes that this is not about being anti-government or avoiding responsibility. The rich contribute to society in other ways by creating jobs, housing, and economic activity. The tax system is structured to encourage that behavior. Anyone can benefit from these rules, but only if they invest the time to learn them. The chapter ends with a challenge. Stop seeing taxes as something to fear and start seeing them as a signal. If you're paying a lot in taxes, it's a clue that you're operating in the wrong quadrant of the cash flow quadrant. As an employee or self-employed, to move to the right side, as a business owner or investor, you must learn how money, debt, and taxes work together. Kiyosaki's conclusion is blunt but empowering. Taxes are not the problem, ignorance is. The more you know, the less you pay, and the faster your money works for you instead of the government. In Chapter 6, Robert Kiyosaki explores how the media influences our financial thinking, often in ways that keep us poor and uninformed. He argues that journalists, while skilled at storytelling, are not necessarily experts in money or investing. Yet, millions of people make financial decisions based on headlines, TV shows, and popular opinions shaped by the media. The central idea of this chapter is that financial ignorance multiplied by mass communication creates collective blindness, and that's exactly how most people lose control of their money. Kiyosaki begins by explaining the role of journalists in the financial ecosystem. Their job is to sell attention, not to build wealth. News organizations thrive on emotion, fear, greed, crisis, and excitement because those emotions drive views and clicks. The financial media is no different. When markets crash, the headlines scream panic. When markets rise, they promote hype and once-in-a-lifetime opportunities. But either way, the public gets emotional, not educated. Kiyosaki calls this the emotional roller coaster of investing. He contrasts journalists with real investors. Journalists report from the outside. Investors act from the inside. A journalist observes and writes about the economy. An investor studies it to find opportunities. Journalists focus on stories. Investors focus on systems. That's why, Kiyosaki says, if you ask a journalist for investment advice, you'll likely get second-hand information, what he calls financial gossip, not real knowledge. Most reporters interview so-called experts who themselves are part of the slow money system, like mutual fund managers or financial planners. The result is recycled advice: save more, diversify, and hold for the long term. It sounds responsible, but it's designed to keep your money in other people's control. Kiyosaki shares how his rich dad taught him to question the source of all financial information. Before you take advice, ask, who's making money from this advice? If a journalist's paycheck depends on advertising from financial institutions, their reporting will naturally favor traditional investment products. That doesn't make them dishonest. It just means their incentives are different from yours. True financial intelligence Kiyosaki says, begins when you stop outsourcing your thinking to the media and start analyzing facts for yourself. He also dives into the psychological side of media influence. Humans are wired to respond to stories and emotions, not numbers and logic. That's why financial journalism often feels like entertainment. The stories are simple, the villains and heroes are clear, and the emotional stakes are high. But money doesn't follow emotion, it follows rules. The rich understand that while others react to the news, they create the news by making bold, informed moves. Kiyosaki urges readers to develop what he calls financial discernment. Don't believe everything you hear, verify it, analyze it, and understand the agenda behind it. The financial world is filled with noise. Your job is to find the signal, read reports, study patterns, and learn from experience, not headlines. The media can inform, but it should never dictate your financial actions. He concludes the chapter with a warning and a challenge. If you let journalists shape your financial beliefs, you'll live in a world of fear and confusion. But if you educate yourself, you'll see beyond the headlines and recognize opportunities others miss. The rich don't chase news. They make informed decisions long before the story breaks. Kiyosaki's takeaway is simple. Financial freedom begins when you stop consuming financial entertainment and start seeking financial education. In Chapter 7, Robert Kiyosaki draws a bold and uncomfortable comparison between most investors and gamblers. He argues that what many people call investing is really speculation, emotional, uninformed risk-taking disguised as smart money management. The lesson of this chapter is simple. If you invest without education, control, or strategy, you're not an investor, you're a gambler. Kiyosaki starts by describing the typical behavior of amateur investors. They buy stocks, mutual funds, or real estate based on tips, trends, or emotions, not knowledge. When prices go up, they feel brilliant. When prices crash, they panic and sell. It's the same psychological pattern found in casinos. Greed and fear take turns controlling decisions. In both cases, the house, whether it's Wall Street, a bank, or a financial institution, always wins. The gambler's money feeds the system because the gambler never controls the odds. He shares that his rich dad taught him the key difference between gambling and investing is control. Gamblers have no control over the outcome. They rely on luck. Investors, on the other hand, build control through education, systems, and experience. They understand the game they're playing and design strategies to manage risk. For example, a real investor studies cash flow, leverage, and tax advantages before buying an asset. A gambler buys based on excitement or emotion, hoping to get rich quickly. Hope, Kiyosaki says, is not a strategy. He also examines the mindset that leads people to gamble with money. Most people are financially undereducated, but emotionally overconfident. They believe that being optimistic or trusting the market is enough. But optimism without knowledge is dangerous. That's why Kiyosaki calls the stock market the world's biggest casino for the uneducated. Millions of people put their life savings into mutual funds and pensions, never truly understanding what's inside or who's managing it. Kiyosaki highlights that professional investors still take risks, but their risks are calculated. They know how to lose small and win big. They invest time before money. Gamblers do the opposite. They throw in money and hope to learn later. This lack of discipline keeps them trapped in the slow money system, where they're constantly chasing returns rather than building consistent cash flow. He explains that gambling behavior is often reinforced by the financial industry itself. Brokers and fund managers encourage speculative thinking because it keeps people trading. And every trade means more commissions and fees. The more you play, the more the house earns. Kiyosaki warns readers not to confuse activity with progress. The fast investor makes fewer but smarter moves. The slow, emotional investor makes constant moves but never gains control. To drive the point home, Kiyosaki contrasts two approaches: the investor's plan versus the gambler's wish. Investors have a plan. They know their exit strategy, cash flow structure, and tax implications before investing. Gamblers have wishes. They hope prices rise and that someone else will buy higher. The investor focuses on systems. The gambler focuses on emotions. Kiyosaki ends the chapter with a challenge. Ask yourself whether you're truly investing or just gambling with a nicer name. The goal isn't to avoid risk, it's to learn how to manage it. Risk is essential to wealth creation, but ignorance turns it into gambling. Education, patience, and discipline transform it into investing. The takeaway is powerful. If you want to win the money game, stop betting and start learning how the game is played. In Chapter 8, Robert Kiyosaki uses one of history's greatest scientific minds, Sir Isaac Newton, to explain how the laws of motion also apply to money, investing, and wealth. The chapter's message is profound yet simple. Money, like matter, follows predictable laws of motion, and financial success belongs to those who understand and use these laws instead of fighting them. Kiyosaki begins by recalling Newton's 3 laws of motion and connecting them to human behavior in finance. Newton's first law states that an object at rest stays at rest until acted upon by an external force. Kiyosaki compares this to people who never take action financially. They stay financially at rest. They save money, keep it in the bank, and wait for things to happen, hoping safety will somehow lead to wealth. But nothing changes until they apply force. In other words, until they start learning, investing, and taking control. The problem, he says, is that most people fear movement. They prefer the illusion of stability, even though inflation and taxes are constantly eroding their wealth in the background. Next, he relates Newton's second law, force equals mass times acceleration, to financial momentum. The more financial education mass and decisive action acceleration you apply, the greater your financial impact. Rich Dad used to tell him, money moves toward people who move with knowledge. That's why successful investors keep learning and taking action. They don't wait for perfect conditions. They create motion through discipline, practice, and smart risk-taking. The poor and middle class, in contrast, hesitate. They lack financial mass knowledge and financial velocity action, so their wealth never gains momentum. Newton's third law, that every action has an equal and opposite reaction, becomes Kiyosaki's lesson on risk and consequence. Every investment decision, good or bad, triggers a financial reaction. If you act out of fear, the market will respond by taking advantage of you. If you act with confidence and competence, opportunities respond in your favor. The universe of money is neutral. It rewards precision, not emotion. This, Kiyosaki argues, is why financial education is not optional. It's a requirement to operate successfully in a predictable system. He also introduces the concept of financial inertia, the resistance to change. Most people remain stuck in slow financial motion because they're emotionally tied to old beliefs. Work hard, save money, and play it safe. These mental habits create friction that stops them from accelerating toward financial independence. Breaking inertia requires what Kiyosaki calls a learning force, actively studying how money, debt, and taxes interact instead of relying on old rules that no longer work in today's economy. Throughout the chapter, Kiyosaki blends science and finance to highlight a key truth. Wealth is not random. Just as Newton discovered predictable physical laws, RICH investors follow predictable financial laws. Those who understand leverage, cash flow, and risk can engineer wealth systematically, not by luck or guessing. He contrasts this with gamblers and savers who keep repeating the same mistakes, expecting different outcomes. Kiyosaki concludes the chapter with one of his sharpest lessons. Financial motion begins with education and intent. You can't think your way to wealth. You must move, learn, and adjust. Money doesn't flow to those who sit still. It flows to those in motion, guided by knowledge and purpose. Just like Newton's laws govern physics, the laws of money govern wealth. And the faster you learn to move intelligently, the faster you escape financial gravity. In Chapter 9, Robert Kiyosaki explores one of the most powerful forces in both life and investing, time. He personifies time as the ultimate teacher, the one that reveals who truly understands money and who doesn't. The key message of this chapter is that time either makes you rich or keeps you poor, depending on what you do with it. Kiyosaki begins by contrasting how different types of investors relate to time. The average investor sees time as an enemy. They're impatient, chasing quick returns and fearing losses. The professional investor, however, sees time as an ally. They understand that wealth grows exponentially through consistent education, disciplined investing, and the power of compounding. Time rewards those who stay in control and punishes those who panic or procrastinate. He explains that many people lose money because they misunderstand the real speed of wealth building. They want fast results, but as Kiyosaki emphasizes, fast money without understanding leads to fast losses. The rich use time to their advantage by building systems that compound cash flow, not just capital gains. They plant financial seeds early and nurture them patiently. The poor and middle class, on the other hand, keep switching investments, jobs, or strategies whenever things get difficult, restarting the clock every time. This lack of consistency kills the compounding effect that makes time so powerful. Kiyosaki revisits one of his core principles: the difference between fast investors and slow investors isn't how quickly they make money, but how intelligently they move through time. A fast investor learns quickly, acts decisively, and allows money to grow over time through control and education. A slow investor acts slowly, reacts emotionally, and wastes time by repeating mistakes. Ironically, the fast investor often ends up achieving financial freedom sooner because they respect the process of learning and compounding. He then connects this idea to the concept of financial cycles. Just as time moves in seasons, so do markets: boom and bust, growth and recession. Most amateur investors panic when the market falls and get greedy when it rises. The rich understand that every cycle offers opportunities as long as you're prepared. They use time not to predict the future, but to position themselves for it. By staying financially educated and patient, they can profit in any economic season. Kiyosaki calls this the time advantage, using cycles, not fearing them. Another important lesson in this chapter is about timing versus time in the market. Many people try to time the market, buying low and selling high, which is nearly impossible consistently. True investors, instead, spend time in the market. They hold strong cash flow assets that generate income regardless of price fluctuations. They don't try to outguess time, they cooperate with it. Kiyosaki also discusses how emotions distort our perception of time. Fear makes people freeze and delay action, while greed makes them rush decisions. Both destroy wealth. The disciplined investor maintains perspective, using time as a filter, allowing poor decisions to fall away and good ones to mature. Father Time, he says, always tells the truth. Bad investments reveal themselves over time. Good investments grow quietly. He closes the chapter with a reflection that ties back to the book's main theme. Losing money isn't always about bad investments. It's often about impatience and ignorance of how time works. Wealth is not built in a day, it's built daily. The person who respects time, learns continuously, and stays in motion financially will always win in the long run. As Rich Dad told him, you can't beat time, but you can work with it. Let time be your partner, not your enemy. In Chapter 10, Robert Kiyosaki identifies for key reasons why most people never become what he calls power. Investors, individuals who control money, create wealth through cash flow, and use financial intelligence instead of emotion. This chapter acts as a diagnostic tool. It reveals the mental and behavioral barriers that keep ordinary investors stuck in the slow money system. Kiyosaki's message is direct. Financial success is not about luck or background, but about overcoming these four internal obstacles. The first reason is fear, specifically, the fear of losing money. Kiyosaki explains that fear is natural, but most people let it control them. They focus more on not losing than on learning. As a result, they play it safe, keeping money in banks or mutual funds, where it earns little and is exposed to hidden risks like inflation and management fees. Power investors, by contrast, don't eliminate fear. They manage it through education and experience. They understand that small, controlled losses are part of the learning process. Kiyosaki repeats Rich Dad's lesson. If you want to be rich, you have to be willing to lose and learn fast from it. The second reason is cynicism, the mindset that doubts opportunities and blames circumstances. Cynics say things like that won't work or it's too risky. often using news or past failures as excuses for inaction. Kiyosaki argues that cynicism kills financial creativity. Instead of analyzing deals, cynics analyze why success is impossible. Power investors, on the other hand, seek information, test ideas, and surround themselves with knowledgeable people. The key difference is attitude. Cynics look for reasons to stop. Investors look for reasons to start and improve along the way. The third reason is laziness, not physical laziness, but mental laziness. Many people work hard at their jobs but avoid the hard mental work of learning how money actually functions. They say they're too busy to study investing or build assets, but that's often a cover for fear and comfort. Kiyosaki stresses that true laziness in the financial world is the refusal to think for oneself. Power investors make time to study markets, tax laws, and business systems. They don't delegate their financial future to salespeople or fund managers. They take personal responsibility for their learning curve. The fourth reason is bad habits, especially the habit of spending instead of investing. Most people were never taught how to manage cash flow, so when they earn more, they simply spend more. Rich Dad used to say, "The rich buy assets first, the poor buy liabilities and call them assets." This simple discipline, paying yourself first and reinvesting profits, separates power investors from everyone else. Without discipline, even high income won't lead to wealth. Kiyosaki argues that financial habits are stronger than financial advice. No book or guru can help if daily behavior contradicts sound principles. After outlining these four obstacles, Kiyosaki connects them back to financial education. Fear, cynicism, laziness, and bad habits all stem from a lack of understanding about how money really works. Education neutralizes fear. Action destroys cynicism. Curiosity overcomes laziness. And discipline rewires habits. The transformation from average investor to power investor begins in the mind, not the market. He ends the chapter by reminding readers that power investing is not about getting rich quickly. It's about building control. True wealth comes when you master your emotions, think independently, and make money decisions based on knowledge, not comfort. Every power investor started as a beginner. The difference is that they faced their fears, stayed curious, worked hard on their mindset, and practiced good financial habits until success became inevitable. In Chapter 11, Robert Kiyosaki introduces one of the most important ideas in the entire book, power investing. This chapter defines what it truly means to be a power investor, explains how they think differently from average investors, and shows why the ability to control money, not just earn it, is the foundation of lasting wealth. The core message: power investors don't chase investments, they create them. Kiyosaki begins by stating that most people confuse investing with handing money to others. They invest in mutual funds, stocks, or retirement accounts without knowing what's really happening to their money. In truth, that's not investing, that's outsourcing responsibility. Power investors, on the other hand, take full control. They understand the assets they buy, the markets they operate in, and the cash flow those assets produce. They never give up control of their money to someone else's system. He explains that a power investor has three kinds of power: the power of knowledge, understanding how money, debt, taxes, and markets actually work; the power of experience, learning from real-world investing, not just theory or advice; the power of control, the ability to influence or directly manage the outcome of their investments. This combination allows them to minimize risk while maximizing returns, not by luck, but through design. Kiyosaki contrasts this with the average investor, who relies on hope, diversification, and long-term market trends. Hope, he says, is not a financial strategy. To make his point clear, Kiyosaki describes how his rich dad used business and real estate as examples of power investing. In business, you create the product, the system, and the income stream. In real estate, you control cash flow, financing, and management. In both cases, you have leverage. You can increase income, reduce expenses, and use other people's money OPM and time OPT to scale your wealth. That's real financial power. The opposite of power investing is passive dependency, giving your money to Wall Street and praying it grows. Kiyosaki also emphasizes that power investors are financial engineers. They design investments the way an architect designs a building, with structure, purpose, and precision. They don't speculate on price, they build value. For example, a power investor might buy a struggling business or property, improve it, and generate cash flow before ever thinking about selling. They don't play the buy low, sell high game. They play the buy, improve, and hold for cash flow game. He warns that becoming a power investor requires education and patience. It's not a shortcut to wealth, but a transformation in how you think about money. Most people want power without preparation. They want the returns of a power investor without the discipline of one. That's why Kiyosaki stresses the need for mentorship, practice, and continuous learning. The true investment is in your mind first, money comes second. The chapter also highlights leverage as the defining tool of power investors. Leverage is the ability to do more with less, to use other people's money, time, and knowledge to accelerate results. However, Kiyosaki cautions that leverage without financial intelligence is dangerous. It amplifies both success and failure. That's why power investors always build knowledge before adding leverage. Kiyosaki concludes the chapter with a powerful statement. Power investing is not about taking bigger risks, it's about gaining more control. The average person avoids risk by giving up control, while the power investor reduces risk by increasing control. The goal isn't to find a perfect investment, it's to become the kind of person who can make any investment work. That's the real power of power investing, turning money from a mystery into a tool you command with confidence. In Chapter 12, Robert Kiyosaki returns to one of the book's central themes, the dangerous confusion between investing and gambling. This chapter expands on the earlier lessons by showing how emotional behavior, lack of education, and blind trust in financial systems turn most people into gamblers who think they're investors. The message is straightforward. If you don't have control, understanding, or a plan, you're not investing, you're gambling with your future. Kiyosaki opens the chapter by pointing out that millions of people are encouraged to invest through mutual funds, 401ks, or the stock market. Yet few truly know what they're buying. They're told that over time, the market always goes up, but this belief turns them into long-term speculators rather than informed investors. They react emotionally to news, chase trends, and panic when prices drop. The irony, he says, is that they don't even realize they're gambling because Wall Street has cleverly marketed speculation as responsible investing. He breaks down the three main characteristics of gambling behavior in investing. Lack of control. Gamblers hand their money to others and hope for the best. They don't control the asset, the management, or the outcome. Dependence on luck or timing. They rely on market movements, believing they can guess when to buy and sell. Emotional decision-making. Fear and greed dictate their actions. They buy in euphoria and sell in panic. By contrast, real investors build control systems. They understand how to manage cash flow, leverage, taxes, and exit strategies. Instead of relying on predictions, they rely on principles. Rich Dad taught Kiyosaki that professional investors always seek control first, returns second. Control means knowing the numbers, the risks, and the people involved. Without control, money moves away from you. With control, it flows toward you. Kiyosaki illustrates this idea with examples from real estate and business. In real estate, a power investor controls income through rent, expenses through management, and taxes through legal structures. In business, they control sales, production, and financial systems. Every part of the investment is measurable and manageable. In contrast, a gambler in the stock market has zero influence. They're simply reacting to forces beyond their understanding. He also criticizes the set it and forget it mentality sold by financial planners. While marketed as safety, it's actually passivity, a disguised form of gambling because it depends entirely on the market's future performance. True investors never forget their money. They review, adjust, and stay engaged because financial freedom requires awareness, not autopilot. Kiyosaki explains that the root of gambling behavior is financial laziness, the desire to make money without effort or study. Many people spend years training for a career but spend almost no time. Learning how money really works, this laziness creates vulnerability. It's why people fall for scams, bubbles, and get rich quick promises. The power investor, in contrast, is a lifelong student of money, always improving their understanding of markets, laws, and leverage. He concludes the chapter by redefining what intelligent risk looks like. All investing involves risk, but risk without knowledge is gambling. The goal is not to eliminate risk but to control it through education and preparation. Gambling depends on hope. Investing depends on systems. Gamblers play for short-term excitement. Investors build long-term wealth. The difference isn't luck, it's learning. Kiyosaki's final point drives the lesson home. If you think investing is exciting, you're probably gambling. Real investing is often boring because it's about discipline, control, and consistency. The power investor wins not by chance, but by design. In Chapter 13, Robert Kiyosaki focuses on a question every aspiring investor asks: how do you actually find great investments? His answer is not about tips, timing, or luck. It's about mindset, education, and relationships. The central idea is that great investments are not found. They are recognized and created by financially intelligent people. Most people never see opportunities because they don't know what to look for or how to evaluate what they find. Kiyosaki begins by emphasizing that the best investments are rarely advertised. By the time an opportunity reaches the general public, it's usually too late. The insiders have already taken the best deals. This is why financial education is so important. When you understand how money and markets work, you don't need to wait for someone to offer you an investment. You can spot opportunities others overlook. The rich don't depend on stock tips or newsletters. They depend on financial literacy and networks. He explains that finding great investments begins with building a strong foundation. In the 4 asset classes, business, real estate, paper assets, and commodities, each has its own rules, advantages, and risks. A power investor studies these classes to understand where they personally have the most control and knowledge. Rich Dad always advised Kiyosaki to focus on one class at a time until mastery. You can't be an expert everywhere, but you can be great somewhere. Once you master a category, you begin to see deals where others see nothing. Kiyosaki also introduces the concept of deal flow, the steady stream of potential investment opportunities that come from your network, experience, and reputation. Deal flow doesn't happen by accident. It's built through relationships and credibility. The more people see you as a serious, knowledgeable investor, the more opportunities will find their way to you. This is why the rich invest heavily in their financial communities. They attend seminars, join partnerships, and build alliances with lawyers, accountants, and business owners. Average investors, by contrast, stay isolated, waiting for the right deal to appear. Another major point in this chapter is preparation before opportunity. Most people miss great deals not because opportunities don't exist, but because they're unprepared when they appear. A power investor keeps cash or credit ready, understands financing options, and can move quickly when a deal surfaces. Kiyosaki compares it to surfing. Waves of opportunity come and go. Only those already positioned can ride them. The unprepared investor watches from shore, saying, "Maybe next time." Kiyosaki also dismantles the myth of the perfect investment. He explains that every deal has flaws. There's no such thing as risk-free wealth. Great investors don't look for perfection. They look for problems they can solve. That's where profit lives. If you can fix inefficiencies, add value, or create cash flow where others can't, you've just turned an average deal into a great one. This proactive mindset separates investors from spectators. He offers practical guidance. Study financial statements, learn tax advantages, and analyze cash flow before committing money. Power investors don't guess, they calculate. They don't chase trends, they understand fundamentals. This discipline allows them to recognize a true deal within minutes because they know what numbers and structures make sense. Kiyosaki ends the chapter with a mindset shift. Great investments are not about luck, location, or timing. They're about you. The smarter and more prepared you become, the more opportunities you see. As Rich Dad told him, the world is full of great deals, but only for those who are ready to recognize them. The ultimate takeaway: Your greatest investment is in your financial education. Because once you know how to find value, you'll never run out of opportunities. In Chapter 14, Robert Kiyosaki explains what truly separates great investors from average ones. Not luck, income, or access to capital, but mindset, discipline, and control. This chapter serves as a blueprint for personal transformation, showing readers how to evolve from someone who depends on financial products into someone who creates financial results. The main idea: you don't find great investments by being lucky. You become a great investor by being prepared. Kiyosaki begins by stating that most people want to have what great investors have: wealth, freedom, confidence, but few want to become what great investors are. Being a great investor takes time, study, and experience. It's not about chasing hot tips or timing markets. It's about developing the skills to identify, structure, and control deals that consistently generate cash flow. Investing is a profession, not a hobby, and like any profession, it requires practice and patience. He outlines several characteristics that define great investors. First is financial education, understanding how money, debt, taxes, and markets interact. Great investors don't rely on hearsay. They study financial statements, analyze risk, and understand cash flow patterns. They know the difference between good debt and bad debt, between appreciating assets and depreciating ones. Their decisions are based on facts, not feelings. Kiyosaki emphasizes that without this foundation, it's impossible to make sound investment judgments. Second is emotional control. Kiyosaki reminds readers that markets rise and fall, but emotions amplify both extremes. When prices soar, greed blinds people. When markets crash, fear paralyzes them. Great investors stay calm in both conditions. They view downturns as opportunities, not disasters. Rich Dad used to say, "When everyone else is running out, that's when you should walk in, if you know what you're doing." The key is not to eliminate emotion, but to manage it through experience and education. The third trait is patience and timing. Great investors understand that wealth builds over time. They don't chase short-term gains. They position themselves for long-term growth through consistent learning and strategic moves. Kiyosaki compares it to farming. You can't harvest the day you plant. You must nurture your investments, monitor them, and let time compound your results. Most people lose because they want instant success. They dig up the seeds before they can grow. The fourth quality is control. Control over income, expenses, and decision-making. Kiyosaki repeats that power investors never hand over control to others. They may work with teams, lawyers, accountants, or partners, but they remain the ultimate decision-makers. Control reduces risk because it gives you the ability to respond, adjust, and protect your capital. Without control, even a good deal can turn bad. Kiyosaki also explains that great investors create value rather than chase it. They don't just buy existing wealth, they build it. A great investor sees potential where others see problems, a property that can be improved, a business that can be restructured, or a market gap that can be filled. This creative mindset turns average opportunities into exceptional ones. He warns that most people never become great investors because they look for shortcuts. They want easy answers, guaranteed returns, or safe investments someone else manages. But safety without understanding equals dependency. The real safety, Kiyosaki argues, comes from competence, knowing exactly what your money is doing and why. He closes the chapter with a call to mastery. Don't focus on finding the next great investment. Focus on becoming a great investor. Once you develop the mindset, skills, and discipline of a true investor, opportunities will naturally flow to you. In other words, the best investment you'll ever make is not in a stock, a property, or a business. It's in your own financial intelligence. In the final chapter, Robert Kiyosaki delivers a direct and sobering conclusion to the entire book. Chapter 15, Winner or Loser, is not about the market, money, or even investing. It's about you, your mindset, your education, and your decisions. The central question he asks is simple but powerful. What kind of investor will you be? One who wins by design, or one who loses by default? Kiyosaki begins by stating that in the financial world, winning and losing are not determined by luck or intelligence, but by awareness and control. Every day, money moves, from the uninformed to the informed, from the passive to the proactive, from the slow investor to the power investor. The financial game is always being played, whether you participate or not. The real question is whether you're playing to win or playing not to lose. Most people, he says, spend their entire lives trying to avoid risk. Yet by avoiding risk, they also avoid wealth. He reminds readers that losing money is not the same as being a loser. Every successful investor has lost money at some point. The difference lies in how they respond. Winners learn, adjust, and grow stronger. Losers quit, blame, and retreat into fear. Rich Dad taught him that failure is feedback, a form of education that can't be learned from books. Every financial setback reveals what you don't yet know. The key is to learn quickly, correct mistakes, and move forward with greater intelligence. Kiyosaki then connects this mindset to the book's recurring theme: financial education as the foundation of power investing. Those who win consistently are not gamblers, they're students of money. They understand leverage, taxes, debt, and cash flow. They study cycles, build systems, and create multiple streams of income. In contrast, the losers of the money game hand control to others, brokers, bankers, and financial planners, hoping for safety. But as Kiyosaki warns, hope is not a strategy. Winners take responsibility, losers outsource it. He also reflects on the importance of speed and timing in financial growth. Winners move fast because they've trained themselves to recognize good deals and act decisively. Losers hesitate, paralyzed by fear or waiting for perfect conditions. But perfect conditions never exist. The market rewards those who are prepared, not those who are lucky. As he puts it, opportunities don't wait for indecision. The ability to make quick, informed moves is one of the defining skills of a power investor. Another insight Kiyosaki shares is that financial winners build systems that work even when they don't. They invest in cash flow assets that keep generating income, businesses, real estate, royalties, and other scalable ventures. This is how they achieve freedom. Their money works harder than they do. Meanwhile, the average investor stays in the slow money trap, exchanging time for money, saving, and waiting for appreciation that may never come. Toward the end of the chapter, Kiyosaki delivers a reality check. The future will always bring change, new technologies, market shifts, inflation, recessions, and crises. Winners don't fear change. They prepare for it. They use education and adaptability as their competitive edge. Losers cling to outdated advice and wonder why the same old strategies stop working. The chapter concludes with an empowering reminder: everyone has the potential to be a winner. In the financial game, the difference is not opportunity, but mindset. Winners commit to learning, taking action, and staying in control of their money. They understand that wealth is built, not given, and that mastery over fear, greed, and ignorance is what separates financial freedom from financial frustration. As Rich Dad told Kiyosaki, the world doesn't care if you're rich or poor. Money doesn't care either, but it will always flow to those who understand how it works. The choice in the end is yours, winner or loser. If this breakdown brought you value, don't let it stop here. Hit that like button, subscribe, and turn on the notification bell so you never miss another deep dive into the best financial books ever written. If you learned something new from this video, drop a comment below and tell me, what's one lesson that hit you the hardest? How are you going to apply it in your life right now? Your engagement helps this channel grow and helps more people get smarter about money. Thanks for watching. Keep learning, keep investing, and remember, financial freedom starts with financial education.